Welcome back to the Beat the Odds Business and Wealth podcast. Trevor, we've had some viewers that have been asking for this show.
Okay. Yeah, we gave a little teaser of it last week saying we're going to be talking about it. But, here we are, and let's get rolling.
We're going to see who's really serious today because we're going head-to-head with the Team Canada game. So we didn't expect there to be a hockey game at 10 o'clock in the morning. But here we are. And so anybody tuning in here live, it's like, well, they're serious about their financial well-being. So that's for sure. So, okay, let's open it up. Like real estate. Canadians are obsessed with real estate, okay? But it hasn't gone that well. Here is the 10-year price history of real estate in Canada. So we top out in early 2022, average home price of $827,000. We are down now to $665,000. It's about a 20% pull down off the peak. Now, it's going to be drastically different based on the area that you live, right? In fact, a lot of our Alberta viewers aren't experiencing any pull down at all, right? But
no, this is probably mainly due to the GTA and Vancouver. Those two locations, probably more specifically than anything else. Remember, at that time, interest rates were extremely low.
Yes. And we're going to get into like why this happened, why this occurred, right? And then how this ties into MicroStrategy and STRC and the preferred share offerings, right? Okay, so what causes this run up to $827,000 average home price? The number one thing, and this might not be a popular viewpoint, but this is my viewpoint. It's not the only factor, but it's the money supply. Inflation is always a monetary phenomenon. Ultimately, this is the biggest hammer, more so than, and this might be hard to, when you hear this, you might react vitriolly for a second, but I just encourage people to put that aside for a second. It's like, it's more important than population levels. It's more important than immigration levels. It's more important than interest rates, and it's more important in jobs. And and that might sound, when you hear that, you might have just been like programmed because you hear about those other issues. No one ever talks about the money supply, but everyone talks about those other issues. So they evoke very strong feelings. But it's just like, if the dollar becomes, the Zimbabwe dollars, and we start printing $20 billion notes, you can have 20% unemployment and still have unbelievably high house prices in nominal terms. So the money supply is the big hammer in the equation, right? Because it's what that thing is worth, like how many dollars are chasing those goods, okay? So variable number one, that is probably the most excluded variable in every analysis, but it's probably the most important.
The money supply.
Is the money supply.
All right.
So when we look here, we had just shy of $1.4 trillion in existence in Canada in 2015. And you can see when those houses start topping out, we go to 2.4 trillion. So just imagine in Canada's existence, it took us until 2015 to get the first 1.4 trillion on the books. And then we add another, and then in 7 years, we add another trillion.
Another trillion, just add on another trillion.
So I'm explaining to you why this happened here. And some people deny this existence and pretend that everything else is somehow more important. But it's like how many dollars we're chasing those goods. Okay. The other variables, it's not that they don't affect it. I'm just telling people, like, this is the one that you need to look into first. Okay. Now, here we have the population. Yes, we had... 10 years ago, we have 36 million people in Canada. Today, we have, 41 million people in Canada.
It's kind of a lot in a short period of time.
Yes, but there was a big run up between, the 36 and the 40. And keep in mind, nothing grew in 2020 because everything's kind of shut down. No one's coming in. The temporary foreign worker program was very difficult to get anyone across the border. Airports were almost empty. I think we flew then, didn't we?
We did, yeah. We did take a trip, and it was a ghost town.
It was empty, right?
Yeah.
Like I was flying all the time, right? But it was almost like you were in some sort of like Stephen King novel or something, right? Where it's just like no one's in the airport, and it's like, why are you there, right? But so here we are. Like that growth, you go from 38 million, really at the end of 2019, and then all of a sudden you ratchet up by 2 million in a really short period of time, right? Mm-hmm. That has an effect. Okay. Now, we also have interest rates, okay? Most people in Canada, despite all the evidence of the benefits of variable rate interest rates, and people are just, again, irrationally scared of debt and how to manage, margins and limits and having a reserve fund and having liquidity. But most people will take fixed income products, okay? They're going to take fixed rate mortgages, which are largely affected by the Canada 5-year bond yield. And you can see at that time, man, people were lending the Canadian government money at less than 1%, okay? For a while, they were lending money at, 0.6%, like just insane levels. Even at today, say what you want, we're still above the mean point. Okay, we're still above the mean point, 5-year bond yield at 2.7%. And you can kind of see the mean point, let's call it 2.5, 2.25. That's, probably the mean revert where we'll go to. And some people will go variable, largely affected by the Bank of Canada overnight rate. Okay, so anyone on a variable rate mortgage, this is what's driving the ball, and we're at 2.25%. So we had a big run up, historically very, very high over the median rate. So hard to qualify for financing, both whether you were going for a fixed rate mortgage or a variable rate mortgage. The underlying instruments that drive that were driving the rates up. Okay, and even now we still haven't got back down to the median. Okay. Now some people throw around the neutral. It's like, okay, whatever Tiff Macklin comes out with in 8 times a year and tells us what's neutral. I'm just looking at what the average is, right? Not based on what the feelings are. We're not hugely over it at this point, but we're not back to the median yet. We're pretty close. Okay. Unemployment. Do you actually have a job, right? And so it's like, how many of these dollars are in existence? Okay. How many people need a house? Okay. What are the interest rates that they can borrow at, whether it's fixed or variable? Okay. And then do you have a job that you can qualify for a mortgage?
Yeah, we had a podcast about that last week, and people are opting to not get a job. They just gave up. They gave up, and the government's answer to that is, well, we need to boost our military, so let's go ahead and get some foreigners in here so we can build our military ranks.
Didn't even drill into that headline. It was so bizarre. It's like sometimes you just gotta like throttle the bizarreness on the intake because it'll just explode your mind. I saw that headline. I'm just like, I'm not even opening this article.
Man,
so
it's crazy.
So we had basically full employment. I would suggest to people anytime you're under 6%, you're basically in full employment, and when you're over 6%, you have a job issue. Okay. That's the cutoff. You got to draw it somewhere. But there, 0 is kind of a fantasy number because there's always people transitioning in and out of the labor market. And as our podcast said last week, it's telling you 6.5, but some people just magically stop working, or stop looking for work, right? And the participation levels is like at historical lows, which, if you're so desperate that you stop looking, should we really exclude you from the unemployed, right? So, I mean, the employment rate is low, very low, right? So,
and I'm not sure if you can look up the data, but seeing how many people are actually on some kind of social assistance, EI, if that's kind of boosted up. I know this time of year is typically your seasonal halt.
Yeah.
So can
EI would be in here,
off, right?
So like the EI would be in like registered correctly. It's the people who are, their EI ran out, and supposedly they've just stopped looking. They've just vanished from the job market. So it makes me think that this is, I'm skeptical that of the 6.5. Is it really 6.8, or is it really have we really, or is it just is it a statistical anomaly, or is it a convenient a convenient update of the analysis, right, to make it appear not so bad? Because these numbers are politicized, whether we like it or not. There's a political motivation to report a certain number. Okay,
Yeah.
so that's housing, people. That's housing, because the false pretense of housing is, well, you never lose money in housing. You never lose money in real estate, right? This is what people say. It's just like, what do you mean? Like, on what planet? People just repeat words that they hear, and they just repeat them over and over, right? And not only could someone have lost 20% on the value of their house, they could have lost everything. They could have lost everything.
Absolutely.
If you went and put, if someone in the GTA put they put a $50,000 deposit down on a $500,000 condo, and now it's only worth $400,000, and they can't get any financing to close the deal. They lost everything, 100%, right? And like, we see, it might not be common, but we see catastrophic losses in real estate. Like, this is just like the average. People could be down 20% from the peak. Okay. Now, if you held on long term, great. If you held on long term, you're still doing pretty good. And this is why we tell people, it's like, you should be buying assets you're prepared to hold for 100 years. If you're trying to make money in 1 year, you're not investing, you're speculating. Okay.
Yeah, that's right.
So if we start looking at that, like there is circumstances where people have really big losses. I mean, I'll give you one, like, especially in condos. We've seen condos condemned. It doesn't happen often, but we've seen condos condemned, where all of a sudden, you got a $300,000 or $400,000 condo, and there was one in Edmonton not too long ago, and had a small fire. And then the engineers come in to take a look just to make sure it's safe before they move back in. They look behind the walls and they're like, uh-oh, this was never built right to begin with. None of those people could move back in. They all still had their mortgages. So they didn't just lose their investment, their down payment. If they bought a $300,000 condo and put $30,000 or $60,000 down, they still were responsible for the mortgage unless they wanted to go bankrupt.
Dang. That's harsh. That is so harsh.
Because you're buying houses on leverage. Now, that's not common, but it happens, right? It happens. And it happens to even single family houses, even to a lesser degree, where you have some sort of catastrophic weather event. And like, I'm jaded because everyone has their own situation, but we have hundreds of clients. So there's always one where it's like, oh my God, that happened, where we have one where, they had a $2 million house, and they had a weather event, and something goes through the roof, and the insurer says, no, I'm not covering it.
Amazing.
This stuff, like, they had it insured. They're like, no, and they're still litigating to this day. Like, we're talking, like, I think this was 7 years ago that this thing happened, right? They can't finance it. They can't sell it. It still has they could sell it, but they can't sell off their potential claim against the insurer, and they still have to maintain the insurance with that insurer because their lawyer has told them that it's going to be harder to come after them if they cancel with the insurer. So to that insult to injury, they're still paying this premium to this insurer who didn't cover the loss to begin with, right? Like, it's just these things happen in real estate, right? So the assumption that everything goes up all the time is totally false. The assumption that there's no risk of catastrophic loss is totally false.
Yeah. By and large, in Canada, real estate has been a safe vehicle for investing for a long, long time. And, like you said, our most popular pastime is exchanging real estate between each other in hopes that it's going to go up into the right.
Yeah.
So, I mean, in all reality, people are conditioned that real estate is the best vehicle here in Canada. That, I think, is quickly becoming false. And like, it's never zero. Like, the risk is never 100% and it's never zero. There's always a little bit of risk in whatever investment you're in. So
It's never zero. Like the average, the historical rate of return of real estate in Canada is 5%. It's under 6%, right? Maybe it's 5 to 6, depending on where you live. But like, that's it. It's 5%. Wait till we teach you what the expansion of the money supply is at the bootcamp. Over 5%. In fact, if you take the expansion of the money supply and deduct the rate of growth in the population, it's still over 5%. So you don't actually get the hurdle rate. People just had this like gain of real estate because they built equity in the house, because they bought an asset that was increasing in nominal terms by 5%, but it was underperforming the money supply. But at the same time, they basically were shorting the currency through the mortgage, right? You know, they took that mortgage out that, you know, as the money supply increases, as their wages go up, that mortgage was fixed at a balance that was paying down. So most of the outsized real returns that you got off the investment was because of the mortgage. But most people don't understand it, right? They're just left with this pot of money and they compare it to the, you know, the 60-40 garbage that they got sold at one of the banks. And they're just like, well, I made more money in my house, but they don't really understand the mechanics of how it worked, right? Now you get some more like sophisticated real estate investors, right? And you get some unsophisticated ones and you get some sophisticated ones, right? And you get some unsophisticated ones who think that if you have a piece of real estate and it's cash flowing a couple of dollars, you know, if you buy a $500,000 place and you got $100 of free cash flow that you've like invented fire or something, and then all of a sudden they have a major repair, and then they understand, you know, this real estate game is way harder than it looks, right? But I would say then you get some other people, they got some hard and fast rules. They've been around for a while. Like, I'm looking for a 10% cash on cash return. So they're looking, I'm going to buy a $500,000 house and I'm going to put $100,000 down and I'm going to have $10,000 of cash flow every year. So after I collect my rent, after I pay my expenses, after I make my mortgage payment, I want 10% cash on cash return. Okay. Let's look at that. That sounds pretty good, right?
Sounds like mystical, magical unicorn parts to me. I don't know somebody who can do that.
It sounds pretty good. I'm telling people it's like long term. I haven't seen a lot long term who don't run into some maintenance issues. So they do it, right? But eventually there's some maintenance issues, and they still make money. It's still a return. But then Mr. Saylor has come along. Mr. Michael Saylor, you know, an engineer, just decides to play. You know, basically he's launched an attack against the monetary system. Okay, so he's turned his software company, MicroStrategy, basically into shorting the dollar. Like this is effectively what he's doing with this, where he is raising equity in the capital markets and buying Bitcoin. Okay, you know, a relatively small software company, and was issuing shares and buying Bitcoin. Okay. Extreme amounts of volatility. Extreme amounts of volatility. I mean, if you think Bitcoin is volatile, wait till you see the common shares of MicroStrategy. Okay. It's okay. Because you're basically buying leveraged Bitcoin. Bitcoin goes up, MicroStrategy is going to go up by more than a factor of the increase in Bitcoin. Bitcoin goes down, you know, MicroStrategy is also going to underperform to the downside. So it's, you know, more volatile than Bitcoin in both directions. And for some people, that's what they wanted. That's what they wanted. Some of our degenerates out there, you've already owned MicroStrategy shares. Some of our fans, I know, I've met you guys at the boot camp. So, you know, we talk about like good allocations of, you know, we know all these asset classes, and I try to, you know, get the indoctrination out of people to think that we're going to pick the right asset class. And then I tell people it's like the right asset class, you know, to pick the right asset class, you're assuming the rules of the game don't change, right? And we guide people. It's like, you know, there's real estate, there's dividend paying stocks, there's gold, and there's Bitcoin. And, you know, what do I think is going to happen long term? It's like, well, I mean, in the next 10 years, I think, I don't know, I think gold will outperform Basically, dividend-paying stocks will probably outperform Canadian real estate. I think gold will probably outperform dividend-paying stocks, and I think Bitcoin will probably outperform gold. That's probably the way it works out. But I tell people, it's like, why are you organizing your life that it'll probably work? Like, that's not really a financial plan. That's not a path to financial freedom. Just like it's not a path to financial freedom to assume real estate's going to go up each and every year.
Right.
Because if someone did that and they played with margin, like they got burned, right? And even if they didn't play with margin, they lost according to the money supply. They did lose purchasing power according to the money supply. So MicroStrategy comes along, and you could buy MicroStrategy shares. Then they come with a series of preferred shares. And so, I mean, we're talking about a company, a software company that was worth $1 billion or two, okay? But then he just starts buying Bitcoin on the balance sheet. So basically selling common shares to buy Bitcoin. Okay, great. And some people will say, well, why don't you just buy the Bitcoin itself? You have to remember when he first started doing it, there was no ETF in the US. So this was the proxy. So if you wanted to buy in any sort of registered account, or if you had any sort of restrictions and you were trying to get exposure to Bitcoin, people were doing it through MicroStrategy. In other places in the world, they're still doing it through MicroStrategy because they don't have access to an acceptable ETF.
Right. Yeah.
So it was a vehicle in. But then, as the ETFs get launched, what's the value proposition? Okay, well, the value proposition was he's going to go and borrow money, okay, to buy Bitcoin, okay? He borrowed $8 billion to buy Bitcoin, okay? So we're talking about they own 717,000 Bitcoin, okay? Most of it has been purchased through issuing common shares and buying Bitcoin. Okay. Then they borrowed $8 billion to buy more Bitcoin. So it's like, yeah, you could go buy IBIT or one of the Bitcoin ETFs, or I can go and issue debt at very low interest rates. So he finds that he can issue debt at very, very low interest rates. And some people will misunderstand that the interest rates were just because of like the COVID period. And to some extent that's true, but to some extent, the nature of the debt that he raised were people who just wanted exposure to Bitcoin upside. So basically, they have an option to convert those loans to Bitcoin. So they didn't want to take the full ride. They were willing to almost give a loan interest-free. So basically, if Bitcoin goes to this level, I can trade it for common shares and I haven't missed out on the opportunity. If it doesn't go to this level, you just give me my money back. The interest was secondary in the deal, right? And you start looking at, I can actually walk through it here on the debt. So you start to see the coupon rate, $8 billion with an average interest rate of 0.4%, less than 1%, right? So this is, why would you buy MicroStrategy at that time instead of, because someone could just lever up the Bitcoin ETF in their own investment account, right? But that's a mark-to-market loan, changes based on the date. This is not loan that has it's not marked to market every day. There's no margin call. People are misunderstanding this. They think there's a margin call. You can clearly see the earliest call date. Okay, the earliest call date is this one here. Okay, so this is December 4th, 2026. Okay. And it's basically going to be due for $3 billion, okay? Like it's going to be due for $3 billion. Okay, that's the earliest time. That doesn't mean that they're going to call it. That just means they could if they're not happy with it, right? They also have an option to convert if the share price was $672 per share. So if MicroStrategy stock skyrockets, would they convert? Okay, maybe. So, but I'm just trying to give you people a high level of like why someone would at that time, because there was the point in time where you bought MicroStrategy just because you wanted exposure to Bitcoin and you couldn't get an ETF in a lot of markets.
Yep.
Then you can get an ETF, but guess what? MicroStrategy could borrow money to get a leverage Bitcoin play better than most people because they have access to capital markets. Okay. Then it came about that, in listening to interviews with Michael Saylor, he basically states that this private debt market that he raised $8 billion was not actually a large market. The bond market as a whole is really big, but these types of private debt, he described it in one of the interviews I listened to a while back as basically like it's a small number of people who meet infrequently and just basically, it's like this small club, and he's like, there's billions of dollars, yes, but there's not trillions of dollars being traded like this. Okay. So he realized, MicroStrategy is never going to be, he wants to be $1 trillion company. He looks at these like the Apples and the Nvidias, why am I not there, right? He realized that this is not the vehicle, right? Issuing the common shares was good, okay, but this is not the vehicle. So he needs a different vehicle basically to attract the masses, the big capital, okay? And I'll give people here's like a visual representation. This is a little bit old, but at this time, the global assets worth 730 trillion with a T. Get comfortable, people talking millions, billions, trillions. Trillion with a T, okay? And then get comfortable, quadrillion. Okay, next, okay? Because we're probably there now, but almost at the time this was done, okay? Real estate. So it means if you add up all the assets in the world, real rough, the real estate was worth 300 trillion. The biggest asset, not just in Canada, across the globe, okay? Cash, money markets and cash, 137 trillion. Bonds, 127 trillion. Stocks, by comparison, 110 trillion. Most people would not understand that they think stocks are bigger than the bonds, or a lot of people probably even think they're bigger than the bonds and the cash put together. They're not, okay? You can see the date of this now because you have the physical commodities, basically, and precious metals, 16, way higher than that now. Gold's way higher than that now. But still, it's a small box here. Still, it's a small box. Okay, so he needs more capital. What's the value proposition of MicroStrategy? And so he comes up with, I'm going to issue some preferred shares. And the first one he issues is called STRK. Okay, issues this in February of 2025. Okay, it had at the time, it was issued with an 8% yield. So they're issued in $100 increments, 8% yield. It now trades below $100, so you're getting an effective yield of 10%. Because the market just decides, okay, what do I really want for this product? And basically, they decide that you can issue it whatever nominal price you want, just like the 5-year bonds that the government issues. You can put whatever coupon rate that you want, but the market will decide the yield that they want based on the price that they're willing to pay. Okay, and so you could have a coupon rate of 0%. Well, that doesn't mean they won't get any yield. They just won't pay full value because they're going to pay below the face value, and that'll give them an effective yield. Okay, so the market decided that this effective yield, and in his engineer brain, I think this had a convertibility. Okay, so this is basically, you can take this unit that was issued at 100, the nominal value of 100, and basically you have the right to convert it to one common share. Okay. Or sorry, 0.1 common share. 0.1 common share. Right now, you wouldn't do that. Okay, you wouldn't do it because why would I take this thing that is basically trading at $80, okay, and giving me an effective yield of 10%? I'm getting an effective yield of 10%, and trade it in for common shares. 0.1 of these will be worth $13. But I have the option to convert it. Sure. So at some point, if this runs, as it gets closer to the conversion price, that call option, if you will, is worth more. Right now, it's pretty small because you need a 6 or 7 bagger from here before anybody's converting those preferred shares to common shares. Okay, but that was number one. The other beauty of these preferred shares, and then he also issues so that's February 2025. That's the first one. The next one is STRF that was issued in March of 2025. Okay. This one here is less risky. It's basically the most senior. So if dividends are going to be delayed or if there's going to be some sort of wind up, these guys rank basically the highest of all the preferred shares. So the debt would rank first and these would be next in line. So the risk of losing your capital is the lowest in this one. They have cumulative dividends. So in some of them, they can not declare the dividends and just start again if there's a cash flow shortage. And this one, they have to pay you eventually. Okay. And that's why this one trades higher, but it has a lower effective yield. Okay. I have less risk, so I'm willing to settle for a lower rate. Okay. That's STRF. And then STRD was issued. It didn't have the conversion, okay, but it didn't, rank like the STRF. So it's non-cumulative dividends. If they decide that they want to skip the dividends, they can skip the dividends if they want, okay? That's where it was sitting. Those three, so were issued February, March, and June, okay? And this puts them on a really interesting path. It was a good value proposition because people don't understand these preferred shares. They can't get called. There is no margin call, okay? There is an expiration date here on these. And so people will say like, oh, Michael Saylor's going to get margined. And other people saying he can't get margined. It's like, it's right here. These are perpetual preferred shares, okay? That shareholder can't go and demand, give me my face value back. They can't. Not today, not tomorrow, not ever. Some of them have the right to trade it in for common shares, but they can't create a cash call. They can't create a margin call. This debt, it's right here. It's not difficult to understand. You can go, I love this site too, because you see all these investments and they got this pages of fluff and stuff, and you just go right on to strategy.com. It's like, here's my numbers. Figure it out. You know what I mean? It's kind of like a Satoshi thing where it's like, if you don't understand it by now, I don't have time to explain it to you. Right? Like,
fair enough.
He just tells people what it is, right? And so this is the first cash call on December 4th, 2026. Okay. And the lender could say, I want my $3 billion. Okay. They could say, I want my $3 billion. Keep in mind, he has $48 billion in Bitcoin. After the drawdown, after this 50% drawdown, his $48 billion in Bitcoin. He also has $2 billion in cash just sitting there. Okay, so $48 billion of Bitcoin they could sell. He's got $2 billion in cash. Oh, and by the way, they raised $4 billion last month. Last month, they raised $4 billion. Okay.
So even if they want to, refund all or, sell back all of their stock, they can, and they've got the cash to do it.
That's right. That's right. And what really accelerated, these were very interesting, and it gave it a value proposition. I was a fan. I saw this like, I'm a fan, right? I don't know if I'm really an investor at this point, like beginning of 2024. I'm kind of a fan of what he's doing. I think I told people, it's fun. My $7,000 annual TFSA limit buying MicroStrategy. 2025, it's fun. My $7,000 TFSA limit is MicroStrategy, right? Even at that point, I'm not really like, is it, am I wearing my investor hat or am I wearing my fan hat? I'm wearing my fan hat. Okay. At that point, I'm wearing my fan hat. It's 14,000. It's a small percentage of my portfolio, but it's fun. It's like tickets to a hockey game. It's not an investment, but you just want to buy a ticket to the game. You just want to say that you were there. Okay, good. Then July 29th, 2025 comes along.
Okay.
And he issues STRC. Okay, so I want people to understand these instruments here. STRK number one, he has raised, these are worth $1.1 billion. Okay, raising $1 billion, nothing to snap at, right? But are you going to get to $1 trillion company with that? I don't know. 1.1 billion. Okay, then STRF here, $1.3 billion. Okay. So people actually liked the more security. Okay. Between the two is like the conversion. I think there's a lot of retail people who don't understand the conversion. I think they think they're really participating in the upside that much. It's like your participation in the upside is very, very marginal. You have an option to convert your units for 0.1 of the common shares, which wouldn't make sense unless there's a 6 or 7x from here on the share price. But nonetheless, that's where we are. Okay. Then you get STRD, which, in June of 2025 has that fixed rate, more risk. You rank lower in the seniority table, and there's no cumulative dividend. So if they decide we're not paying, we're not paying. There's no conversion here, and you get it in the yield. Okay, this is the most. I would say it's the most risky product, and you're getting 13% because of it. Okay, but anytime they can skip that dividend. Okay, that's what people don't understand. It's like they can skip these dividends. Only one of these is non-cumulative, and which means like they can still skip it. Just eventually, when they start paying, they got to pay those out, right?
Gotcha. So they hold on to it in order to a later date.
There you go. Yeah. There's another $1 billion. Okay, so it's 1,081 million. There's another $1 billion. Then July 29th, 2025, he comes up with STRC. And it might seem like all three of those were fixed rate, 8%, 10%, 10%. The two 10%ers have different seniorities. And, one of them has non-cumulative dividends and one of them doesn't. Effectively, that's the main crude differences. There's some other differences, but those are the crude differences between them. Now you get to STRC. STRC was different, right? And he talks about that he actually developed this talking back and forth to AI. This is how he came up with this thing, right? Now, he's raised $3.4 trillion.
Wait.
One instrument, one preferred share.
Billion.
3.4 billion. Yeah, sorry, getting ahead of myself. You're right, Trevor. 3.4.
Hang on.
Yeah, we're not there yet.
3 trillion. Woohoo.
Not there yet, right? But maybe foreshadowing some things to come. So $3.4 billion, and this is since July 29th.
Dang.
This
Fast.
is the biggest preferred share issuance in history. I mean, you issue these things. You don't really know what the market's going to take off until it does. But then, why did this happen? What is different about this? This has a variable rate. The first three are fixed, 8, 10, and 10. This has a variable rate. What that does, when you have a fixed rate, if you're trying to normalize the price for your investors, all you can do is issue more or buy them back. Okay, but this gives two ways. So with STRC, you can issue more if you're trying to normalize the price for your investors to make them feel comfortable. Because remember, all of these preferred shares are for people who don't want to ride the roller coaster of the common shares.
Right.
The common shares theoretically will get paid the most over time, but they're going to have the wildest fluctuations in this very long journey that he has embarked on, right? So this one here, so what happens with STRC is he has the ability to dial the dividend up or down. So not only I can issue more, not only I can buy them back, but I can change the dividends incrementally every month. There's some restrictions on how much you can increase or lower, but pretty much they have two dials, okay? What that allows them to do is peg this thing. Okay, so now this one here has the lowest volatility, right? And what got me really interested, recently was, okay, this is new. People who have been to the bootcamp, like we tell people, we show you a sample treasury and we show you shares that have been paying dividends for at least a decade. And in that decade have grown the dividends that have never cut the dividends, okay? This has been going for like 7 months.
Not quite 10 years.
The complete opposite, right? But what happened? I think, Bitcoin's part of a healthy portfolio. It's part of a healthy portfolio. It's like, I don't understand the no coiners, and just like I don't understand the no real estaters, and just like I don't understand the no stalkers and the no golders. I don't understand just the aversion to the true diversification. I think that that's just becoming like some sort of religion or tribalism, right? Like even if you like an asset, you should recognize the risks of that asset or you're not being honest, right?
I got my 60-40 split. I'm good. I'm good.
So you see Bitcoin coming down, and I posted on the Instagram channel. It's like 88,000 bucks. I'll buy another Bitcoin. Okay. So you got to remember, my journey into Bitcoin. I started buying Bitcoin in 2022 at about 40,000 Canadian. These are all Canadian dollars that I'm saying here. And I'm buying all the way down to 20. When it goes down to 20, it's like I had conviction in the asset. I'm more excited to buy at 20 than I was at 40, right? In fact, it took me a while to get off the edge because, not too long before that, it was trading at 80,000 Canadian, right?
Yeah.
And so it wasn't until I hit 40 that I'm like, I got it. I see these persistent deficits. There's no fixing this thing. There's no turning this ship around. The governments have no plan. It's just debase the currency. We all need insurance. Bitcoin and gold is the answer. Okay, I start buying at 40, down to 20. And then, regulatory changes, things happen. I buy a bunch more at 40,000 Canadian. Ride it all the way back up to 170. I think we touched 170 one day Canadian. Okay. And so when it starts crashing, it's like, do I not believe in the assets? No, I bought it forever. I don't think people understand. It's like, I'm not buying quality assets to sell for fake cryptocurrency. I'm buying it because I can generate cash flow with all these assets, including Bitcoin. Okay. Now the options are somewhat limited, but they're already there. I can already generate yield on Bitcoin. I'm not planning on selling my assets off, right? I'm planning on generating cash flow from the assets, and that's what we show people in the bootcamp. Okay, so it goes down, and I post, 88K. That's my target. I put two lines, like 88K. That's my 50% drawdown. That would be close to previous support levels. I'm not a technical trader. I buy assets forever, and it was close to the 200-week moving average. And so you get there, and it's like, that's too good of an opportunity. That like every once in a while something comes along. It's like 88 is target number 1, 44 is target number 2. So at 88, I'm going to buy another Bitcoin. At 44, I'm going to buy another Bitcoin. Do I need another Bitcoin? No. Was it a good portfolio allocation? Would I have looked at that with a client and made the same recommendation? No. But I like having some fun sometimes. So I'm going to buy another Bitcoin. Okay, great. So 88,000 bucks, I'm going to buy another Bitcoin. And then what happens? This is why Bitcoin wins, is my $88,000 transfer got hung up.
Yeah, I know. It took like a week.
2 weeks.
2 weeks.
2 weeks. It took 8 business days for them to release the money. It's like, I tell everyone, it's like, this is how I always know Bitcoin's going to win in the end, because it's not my money. You know what I mean? It's like the only money, if you want to move if you want to move hundreds of thousands of dollars tomorrow immediately.
Nope. You can't.
No,
you can't.
I can with my hardware wallet. I can, right? Okay. But that's kind of what transpired, but it made me look at what happened with STRCs. My plan was I'm just going to buy Bitcoin when it hits. Then it hit, and I still could have bought it. I didn't get, it was like 92 or something like that, but whatever. Could still buy it at that point. But something interesting happened that really got my eye. This here, it didn't break. The peg didn't break. Bitcoin went down 50%, and STRC did not break, right? Remember the Terra Luna algorithmic stablecoin back in the day? So it's like, now you have an asset. It's only 7 months old. But now it's had its first drawdown. Its first real Bitcoin bear market, 50% down. And what happened? Regained its peg within a day. Bitcoin price didn't recover. We're still kind of 40% down, maybe not the 50% down, but it regained its peg. That was interesting.
Yeah,
that was it, and that was the point where I was no longer a MicroStrategy fan. Now I'm an investor. Now I'm gonna buy more than $7,000 of my TFSA room. Now I'm going to put some real capital there. So when those funds finally hit 2 weeks later, what did I buy? I bought common shares of MicroStrategy. Okay, so this was in a Wealthsimple account. By the way, I actually wanted to buy, half MicroStrategy and half STRC. That was, at first I'm just going to buy Bitcoin, and then I see, wait a minute, this thing held. But then I realized there's no preferred shares in Wealthsimple, whatever. So my goal is to generate cash flow out of this, and I show people how we do that with margin. It's like I can buy MicroStrategy shares. I'm like, now I look in that portfolio. It's like I can't actually buy the STRC. Okay, I want a little less, more diversification. So I took the other half, bought a gold ETF. I'm going to borrow off that. I'm going to buy dividend paying stocks. That's how I'm going to generate my yield. Not selling anything, right? And I'm going to generate that yield basically tax-free, right? Because I have the interest write-off on the margin loan. So that's how I did that trade. And, simultaneously, I also looked at, in our corporate treasuries that we help people manage, we're always buying money market funds, right? One of the biggest ones in Canada is BlackRock's CMR. Okay. Coming down, we were getting 4% not too long ago. And now we're getting 2% on the yield, but this is, how we really organize corporate treasuries. Unlike the banks who, you could show up with $1 million any day of the week, any month, any year, and they always tell you it's a good time to deploy capital. It doesn't matter. Day. It's always the time, and I think that's probably driven by the fact that their fees start when you deploy the capital. Where I would be like, there any significant sum, it's like 2 years. I'm waiting. I'm going to deploy slowly over 2 years because that's the regular historical trend of you not making a bad decision and deploying at the wrong time. And, the U.S. dropped some bombs on Iran tomorrow or something like that, right? And I could have bought way cheaper.
No, it's aliens. Aliens.
Yeah.
Aliens are real, so that's going to change things there for your yield.
So, I was able to then, basically any cash or CMR that I was holding in my corporate portfolio, then I was able to buy STRC just because it's not a Wealthsimple portfolio. It's one of the big banks I still have there. So giving them a couple bucks on that. I like the trading platform a bit, right? So, and I like the research functions on that. So that's where one of my corporate portfolios is. So STRC. Would I do that with a client's portfolio? No, but I think this is a research and development thing. It's like, because if this thing works 10 years from now, this will pass my threshold. Like 10 years from now, it's like, why am I buying? Like, this thing doesn't not have any, this thing here does not have any volatility anymore. We know that it can recover in a 50%. I almost wanted Bitcoin to go down 80% just to truly battle test it in the depths of a bear market, just to see if this thing would hold. Would this peg hold, right? But it did definitely hold at 50%. And people have to think about this. It's like now you have an instrument that has very, very low volatility, like a money market fund. And one of them is paying 11%, and the other one is paying 2%. And it gets better, Trevor, because it's not just 11 versus 2. The 2% is taxed as interest. It's taxed at the highest possible rates. It's taxed as other income, okay? The 11% is taxed as a return of capital, okay? So until you get your entire initial contribution back, you actually don't pay any tax, okay? Once you start getting preferred share dividends that are taxed as a return of capital in excess of your regular cost base, it becomes a capital gain that's still taxed at 50% of the level of interest. And even if they go up and they raise that in the future, which I think they will, it would still be, a third cheaper than it would be the tax on interest, okay? Which starts right away on day one. Okay?
Well, my question is, all right, so it held when there was a 50% drawback in Bitcoin, and it held. Question from me is, what are the factors that made that possible? Is it because the way that he DCA'd into Bitcoin over time and invested when it was like low all the way up to its high and then back down again because of the diversity of the price that he got it at? Like, why did it hold so well?
the engineering and the yield. So when this was launched, I believe it was launched at 10%, and then you had to dial it up to find what's the interest people are willing to pay, and so he's able to change that yield. So it's just, what are people's options? We're looking at the Canadian market, but let's look at the U.S. market. You're talking about, am I going to buy a U.S. money market fund and get 3%? Am I going to buy a 10-year government bond and get 4%? Or am I going to buy this at 11%? Those are their options, right? And they have the ability, because they have the cash, that they're able to issue units, buy units back, or change the rate on a monthly basis. So it was that flexibility that he can fine-tune it and strip out all of the volatility, right? And it was interesting because that's just the psychology of what the market wanted. Because if you want the absolute maximum rate of return, the common share is the vehicle, but you're going to have the wildest ride on valuations, okay? And then if you wanted the least volatility, STRC. So if you look at all the other preferred shares, they're in the middle, okay? You're going to have some volatility, but then it turns out that the market, they just wanted the two extremes.
So what we're saying is, like with this one, STRC, people are just parking money there for use at a later date, kind of like in a money market fund, or are they looking for the yield and the dividend payoff?
I think at this point, now you're actually investing. Like, so when we buy a money market fund, we know we're underperforming the money supply. It's not really an investment. Yeah. People think that it's low risk. I'm like, no, that putting money in a low rate of return, whether I put it in paid off real estate or whether I put it in a money market fund, I'm losing money on a real basis when you compare it to the money supply. When you compare it to population growth and money supply, I'm losing money. Okay, they grow the money supply by 8, and the population grows by 1. If I don't get 7, I'm going backwards. Okay, but I'm willing to go backwards for a little bit because then it helps me from preserving capital. I don't jump off a cliff on my entry point. Okay, so if I'm getting more than that, if I'm getting 11, I'm actually moving forward. Okay, I'm actually moving forward. Like 11%, it's like, we teach people, we show people portfolios of the quality dividend paying stocks that you can buy in Canada that have a historical rate of return of 11% over the last 30 years. Okay, and it blows their mind when they actually find that there is a segment of the stock market that has that and has that preferential tax treatment. But that's, so it's actually a legitimate long-term investment. It's a legit, and you start looking at this, like, go back to that thing. It's like, not just Canadian real estate. So there's someone out there being like, oh my God, I bought this. I heard about my friend Jim, and he bought this pre-con condo, and he put a $50,000 down payment. He lost everything. And now, in fact, the developer's going to sue him, like, hey, for the other $100,000 he needs to come up to close if he doesn't. So he lost more than the $50,000 that he put down, right? And they start looking at the risk factor here. It's like, I could just buy STRC, and this thing pays me 11% a year. It's paid every single month evenly. Compare that to real estate. It's like, is STRC ever going to call to say the foundation cracked or the water's not working?
No.
Remember, going back to that, I want that 10% cash on cash return. Well, here's your 10% cash on cash. It's 11% cash on cash return. And the risk level, I would say, is not that much different than any one piece of property. Now, I'm not saying if you have a diversified, portfolio of properties that has more history and staying power. I'm just saying one property in one location, because people are just not understanding the balance sheet of MS, of MicroStrategy. I hear these liquidation calls. It's like they got 48 billion people. They got $48 billion, okay, in Bitcoin. They got another $2 billion in cash. They can pay their dividends for 30 months without raising another dollar. They raised $4 billion last month. Okay, this convertible debt, it's not like a margin account. It's not like if Bitcoin wicks down to 4,000 tomorrow or 10,000 that he gets margin call. It doesn't work like that. There's a specific conversion date which they can plan for, right? And so you start doing the math on this. It's like you start to talk about there's no issue with the security until Bitcoin's at $12,000. And I start like I was doing this exercise with a small business owner, a successful small business owner yesterday, and just comparing this balance sheet to a successful small business to show them how comically well capitalized this company is. How comically well capitalized this company is. And you know what Saylor has said, now that he's invented this product that has just, you know, most successful preferred share issuance in history. This might be the most important financial instrument of our lifetime. Bitcoin's a commodity. STRC is a financial instrument. Because I tell people, like, MicroStrategy was kind of like a bridge from the TradFi world to the digital world. It was a bridge. It was a bridge. It was a way to get access. All of those other preferred shares, they were all smaller bridges, okay? Different in different convenience levels. The debt was kind of like an airplane and a landing strip. It was fast, but it had very limited capacity. STRC is like shipping liners. It's the big freight liners. It's like when you want to move thousands and thousands of tons of material, when you're moving oil around the world, when you're moving timber around the world, you're moving coal around the world. It's like when you're moving goods from China. It's not on a bridge, it's on a ship. And it's coming in by the container, okay? This capital is immense. You know, we're talking, you know, at least, we're talking cash of $137 trillion. We're talking real estate of $300 trillion, okay? Cash of $137 trillion. Bonds of $127 trillion. You know what happens if 1% of those people are like me? Even 0.1% of those people are like me. It's like, I don't want another real estate. I don't want it. I could have bought a piece of real estate with that money that I deployed. I put a down payment, find another tenant, find another property. It's like, I want another tenant like I want a hole in the head. Like, I don't want to deal with it. Like, it's just not, like, even if I could get paid a little bit more, I just don't want the hassle, okay? I just want to see my distribution into my account every single month, right? You know what happens if 0.1% of that $500 trillion does that?
Man,
you know what I mean?
Crazy.
That's a lot of money. 50 billion. Just that. Like, just that. You know what happens if 1% does that? Okay. If 1%, you know, if 1% of that 500 trillion does that, it's like, that's $5 trillion.
Dang.
There's nothing better like that, right? And compared to real estate on a tax perspective, because people don't understand the tax perspective. It's like, what happens with real estate is they're like, well, in real estate, I can get it tax-free too. It's like, no, you're claiming depreciation on real estate. You're claiming depreciation on real estate. So as you get your cash flow, yeah, you might not have any tax because you're claiming depreciation. But then what happens when you sell? You have something called recapture. Recapture is not a capital gain. It's taxed at the full rate. The only part that's a capital gain. So if you have a piece of property, you buy it at 500, you depreciate it down to 300. Yeah, you didn't pay any tax on the $200,000 there of income, you know, excluding the depreciation. But if you eventually sell it for 600, you have to pay all of those tax savings on the 200. It's taxed at the full rate, and it's only the difference between the 500 and 600 is on the capital gain. This one, every dollar of the gain would be a capital gain. The tax preference is there too. And so I'm sure when they wrote the tax codes, you know, they wrote it for preference for real estate investment. It really is when you look at it. It's like when Michael Saylor and his engineering brain talking to a bunch of AI one night just discovers that STRC is going to be the way to go, and it's the most successful financial instrument, most successful preferred share ever issued in the history of capital markets. Period. Full stop.
What I find interesting about this in particular is, so people, they want to put their money somewhere, okay? And they're not exposed to hard wallet Bitcoin, actual Bitcoin, physical, and they're also not exposed to ETF Bitcoins. This is a different animal altogether. They still get exposure to Bitcoin, but they're not buying the paper Bitcoin ETF that's controlled by BlackRock or Vanguard or the big banks. It's very interesting. They get to deploy their capital receive a gain on it. But again, they're not buying Bitcoin on a hardware wallet, and they're not buying an ETF.
They don't have to deal with the hardware wallet and the setup and the accounts, which is, there's a lot involved in that. There's a lot, we help some of our family office clients. We show them how to do that. There's a lot going on there. Like how, what sort of wallet you use, how you update it, where it's stored, how that seed phrase is recorded, where that's stored. Like there's a lot that's involved in that. Okay. STRC by comparison is very, very easy. It's very easy transferring to one account. And I don't think people understand. It's like, we're looking at anything above $12,000 Bitcoin fully capitalized. So at $12,000 Bitcoin, now you start to get to the point where, if you had an 83% drawdown, now your Bitcoin in reserves is about where your debt is. The preferred shares don't matter because they can't call the debt. They can't. They might be unhappy. You might have trouble raising more capital, but they can't call the debt. Okay. And this stuff is all stepped out. Like it's all stepped out where, they have the $3 billion coming up later this year, but they raised $4 billion last month. And the long-term plan is like, you could see it on Michael Saylor's Twitter the other day. It's like he plans to equitize the debt. So this was a good toy. He found it in the depths of COVID where he found this money at a really good rate and this private market. He realized it's not that scalable, and it makes people nervous because people just think, that's coming for renewal, and they just don't compute how much you raised in the last month and the last year versus how much cash you have and how much reserves you have and how much you've reserved. And so it was just simpler. They're going to put it on preferred shares. He says, I'm going to equitize it, which means he's going to issue more preferred shares, I think. And basically you're going to actually see that debt come down and get added to here, which means there will be no margin call. There will be no price at which they would ever be forced to sell. I mean, right now the price is so low and it's not like if it wicks down to 12,000 for a day that this would happen. It's like if it wicks down to 12,000 when that comes up for renewal, now people maybe start asking some questions, but like you're talking about a risk that's just not there because remember, they still have $2 billion in cash. They still have $2 billion in cash just ready to go, right? You better believe they're going to have $3 billion in cash as this becomes due, or they're already going to know if that issuer wants to roll it forward, right? And a lot of that debt, they'll probably never pay that debt because they'll exercise their conversion rates, right? If this is successful, they're going to issue their conversion rates because you can see the conversion price, $183 per share. This one that comes due in 2027, things work out. They're probably never going to pay that. They're just going to get common shares, and they'll want common shares. Share prices, maybe it's at $200 a share or something at that point. They're not going to want their 1.1 billion back. They're just going to say, give me the shares. They're worth more. The shares are going to be worth more, right? So you start to see this. It's like, you want your 10% cash on cash return? Is this money, going back to the title of the video, it's like, is this the death blow for Canadian real estate? No, but it's capital that's going to come out of not just the Canadian real estate market. It's going to come out of every single real estate market around the world. It's cash that's going to come out of banks. It's going to come out of stable coins. It's cash that's going to come out of bonds. It's like, because now, what we're heading towards is the U.S. is going to lower rates. Warsh has said he wants to lower rates. He wants to shrink the balance sheet and lower rates. There's $8 trillion in money market funds in the U.S. There's $8 trillion getting 3%, right? And they've decided that, I'm not crazy about lending the U.S. government money at 4% for 30 years. I think that's risky. That's what these investors are saying.
Right.
But if you give me 3%, I'll lend the U.S. government money for 90 days. That's pretty good because you have two risks when you buy bonds is you have the repayment risk and you have the duration risk. Okay. So if circumstances change a little, your long bond price changes a lot. Okay, if circumstances change and you have short duration, you don't have that same sort of risk factor, right? But as that goes down, historically that number in the money market fund isn't 8 trillion in the US, it's 3. So there's going to be 5 trillion at least, maybe certainly 4, maybe as much as 5, that once those rates in the money market fund are 1 or 2%, they're going to say, I don't want 1 or 2% anymore. Some of them will say, okay, now it's worth it for me to buy long bonds at 4%. Some of them will go buy real estate. Some of them are going to go buy stocks. Some of them are going to go buy other bonds. And some of them are going to go buy STRC. And that is going to happen. You're going to have the rotation of this because this is an instrument that right now beats the money supply. It beats the money supply, even adjusted for, it beats the money supply nominally, even, not alone just adjusted for population growth. And so at this point, now there's a path, like this is path to $1 trillion company. And maybe some people don't understand. It's like, what is the math behind the preferred shares? As long as the compound annual growth rate over time, not in any 1 year, not in any 2 years, not in any 3 years, as long as the compound annual growth rate of Bitcoin is more than the rate paid to the preferred shareholders, the common shareholders will be the benefactor. Effectively, if they can lend money if they can borrow money at 11% and they buy an asset that increases by 15%, they win. The common shareholders win. The preferred shareholders are happy because they got a low volatility instrument. And good luck trying to find a low volatility instrument that has any hope of keeping pace with the money supply. Good luck, right? Gold would be your best bet until now. And we saw how volatile that was a month ago. It's
crazy, right? Yeah, crazy.
And now there's an instrument that actually exists. Now, over time, you won't get 11%. Like it just, like if it works, that rate will grind down with the level of risk, right? But theoretically, that ends up, somewhere around what the actual expansion in the money supply is. If we're dealing with a sophisticated, unemotional investor, it's like, with a percent of, for risk here or there, but eventually that should normalize around the growth in the money supply. That's my prediction of where that goes. Whether right or not will yet to be seen, but this is the path where, this could potentially be $1 trillion company. Now, am I going to sell all my Canadian real estate and buy MicroStrategy? No. Just like I tell people, it's like, I'm not, right? But at this point, this is now an investable asset. Do you need you don't, even if you hold, even if you hold an ETF with Bitcoin, or if you hold Bitcoin in a hardware wallet, you'll be the benefactor because, this guy is tapped into, basically tapped into a $500 trillion pot. And, I think he has an instrument that could capture, I think it's, probably 500 billion would be a pessimistic assumption. Could he capture 1% of that? This could be that STRC could be a massive, or instruments similar. Other people will copy this, right? And to your point is like, I see this, and some of the disappointment was MSTR didn't get listed. The banks try to put the lid on it and make sure it didn't get into the S&P 500 and like put all these restrictions on getting into index. It's like the indexes are small change compared to the market that he's tapping into. Remember, the equity market is much smaller than the real estate market, much smaller than the cash market, much smaller than the bond market, right? He's tapped into the big boys on this one. And so that is, this could very well be the most important financial instrument of our lifetime, and it just got its first battle test. Is it 10 years old yet? Is it to the point, does it pass my historical test? Is this yield been secured for a decade? That's usually that has been my thesis. No. So is it, do you bet the house on it? No. We get clients coming in, I got $1 million. Okay, I'm going to go buy CMR. No problem. I'm going to buy CMR while I'm wait to deploy that capital. Okay. Would I buy $1 million tomorrow of STRC if someone's worth $1 million? No. I think that's really bad risk management for someone to do. I would in a corporate treasury that we're managing, I would recommend against that, right? But could we be there in 10 years? We could be at the point where this becomes the vehicle. So that's what I got. Let's see what we got in the comments. We got some people who are not watching the hockey game and commenting here. So.
Yeah, there's a few people here. Let's go back to the top.
All right.
Okay. All right. So Travis, hey, thanks for showing up, Travis. Appreciate it.
Travis is a hockey fan, but he's watching. I guess he's watching our podcast. Okay.
Man, he can record that stuff.
Yeah.
Okay. How are you guys not connecting that the money supply, inflation, is the part that is required to make money in real estate? From Lane Walters.
How were you not I think we just did recognize that right at the beginning. I don't know if he's talking about other people or us, but that was our first recognition right at the beginning, that it's the most important vehicle, most important variable. So.
All right. So from @BloodyWasher, hey, thanks for sharing this info, boys. It's just too bad most Canadians are too hard-headed and self-interested to act on it or truly appreciate the alarm bells going off around them.
That's okay. I mean, all you can do is, it's better for you. It's better for you, right? Because I think 11% I actually think people are getting overcompensated for the risks that they're taking in STRC today, right? As part of a diversified. It's not to the point where it's like it's a true a baseline asset where I'm just parking something in a low, kind of a more guaranteed low volatility instrument. But like, these are opportunities. It's these niches. It's these information arbitrages that provides the opportunities, and they're still there. Yeah.
Okay. So the next comment here. From the same guy. I bought my house cheap outright up north in 2023, banking on zooming out and waiting for after World War III for my profits. Just kidding. Probably get moved into some neo-sterilized communal radiant city village or something.
Well, there's some opportunities. I mean, that's why we joke around. It's like, we really hope Bitcoin wins, because if not, we probably all end up in shipping containers on our universal basic income eating our bug paste. But I would suggest that even if things fall apart, we don't know. Like, I think if Bitcoin wins, that it's a better outcome, right? But in the event it doesn't, it's like, we're positioning for that. Like, I see some comments that sometimes like, oh, you guys forget when the Canadian government froze the bank accounts. We absolutely did not forget that. Yeah. We run clients through, what our risk mitigation strategies are. It's like, and it's like there's some people who think they're going to buy an acreage in Stony Plain or something and hide from the government. It's like, I think it's the person who needs a spreadsheet to identify all their accounts. It's like, that's the one that the government is going to have a really tough time shutting them all down, right? Like, because we got when they started confiscating the bank accounts. This might not be known. I don't know if I've ever said this or this was ever said publicly, because I don't think people know. It's like, because we manage clients who bank at all different places, all of the big 5 banks were down that day. After Christy Freeland went on, all of them were down. Interesting enough, the credit unions were not down. That's just a food for thought. Yeah. They weren't down.
And also remember, you were in the Cayman Islands around that time as well. No, that was around the Ukraine war thing.
That's
Cayman Islands, supposed to be secure banking. What were they doing?
Confiscating the trusts at the lawyer office.
That's right.
Right in front of me.
Yeah.
Yeah. So
your money's not safe.
Yeah. So
okay, next one here. All right. So Burt Forrester 5625. Most people are too busy watching sports to pay any attention to what's going on in the world.
That's right. Pretty soon they're going to distract you with some aliens too. That'll let you stop talking about it too.
Going to be some false flags there. Next one here. Speaking of sports, was trying to consolidate my RSPs from Sun Life, old BS corporation that forces you to invest in these companies anyway, trying to contact them to do a transfer of registered funds. Yeah, good luck. And they're giving me the typical, well, you need this and you need that. You may need to keep multiple providers. Meet with this professional. Emailed him about the form and if I can transfer to my current corporation. Yeah, they get you into these things, but they don't want to let you out.
Show you how to wind out. Yeah. So generally, that's a more of a specialized thing. I would recommend attending the bootcamp. We'll give you some general guidance, but like transferring from a registered account directly to a corporation, it's like that might be a long-term goal, but a very bad short-term idea. So navigating how and when to do that is very important. So,
okay, let's see here.
Took me 6 weeks to get out of CIBC.
Wow. 6 weeks to get his stuff out of CIBC. That stinks. RSP company. All right. So we talked about that. Next thing here. Somebody wants to sell some more extra life insurance. Yes, of course. So here we go from...
That's always the one. The life insurance sold by fear, right?
Yeah.
I mean, I hope people keep buying life insurance because I own shares in all of them, but I'm not buying them as a, your decision to insure and your decision to use your insurance or investment are two different things. And we explain why you should evaluate those independently and know what the rates of return are. So,
okay, what did you want to tax here?
Oh man, I'll let you pick them off there, Trevor.
Okay, lots of comments. From Bloody Washer, thank you for participating in our chat today. Lots of stuff here. No real questions, a lot of comments here. Hardware wallets. Most people have third-party or, like me, base wallets where you kind of rely on a middleman. Only use semi-government approved apps. Lots of regulation, no official recognition. But base has to be addressed by the Canadian government at one point, which is why I'm going to something else, CBDC. All right, so, okay, lots of comments. So we have another question. Let's see if we can find a question here. Your math on real estate, long-term increase is less than 5%, closer to 4%, but you buy with 5-to-1 leverage that tenant pays for. Turns a 4% return into 20% on cash in. Then you also have cash flow and pay down. So what are your thoughts on that?
You forgot maintenance. You forgot property taxes. You forgot you forgot management fees. You forgot insurance. You forgot a whole whack of things. So on the let's say you're treading water on the 80% because you're paying 4% interest and you're getting your appreciation. So you really just some people could look at the debt as in a model, you could look at the debt as a trade-off, but you just got to look at like what else I would have bought. You got to compare that stream to what else you would have bought. And, are you getting a 20% growth rate in real estate? No, you're not. Like I've seen these portfolios grow over time. Is it 5 if you do it with the leverage? No, it'll be much better than 5. And then most people don't actually understand it's actually when you commingle the real estate with eligible dividend paying stocks, so you get the true tax benefit from the whole thing. So it's not just using the leverage to buy more real estate, which is kind of clunky because you can't go buy a tenth of a house, but you can use leverage to buy dividend paying stocks at the same time. You make your balance sheet look even better, and we can get even more leverage from the creditors too. So leverage is an important, like we actually recommend, buying paid off real estate is more of an emotional decision than a strategic decision. People think that debt is bad. It's like there's a rate of debt that's bad, right? There's also, you have to understand that your real estate is illiquid. If you have a problem with generating rents at this time, what is the liquidity in that, right? And so we're not against real estate. That's not what we're saying. What we're saying is like it's an illiquid asset, okay? It doesn't keep pace with the money supply. Debt is an important aspect of it. There's 2 assets when you have a piece of real estate. It's the real estate and it's the financial instrument that's basically short selling the currency. Now, what do you do with that? Do you go buy more real estate, or do you have a mixture of liquid assets and you understand the gross rates of all of the things that you're buying, and if those things are correlated together so you don't go down at once?
Yeah, for sure. So hope that helped out on that question. Let's see here from Paolo Batista. STRC isn't listed on Wealthsimple. I agree what you say here, but how do I get involved?
Probably like Questrade. Questrade are one of the big bank platforms. They'll get you access to STRC. Unfortunately, Wealthsimple, I think a whole bunch of people have filled out the form on Wealthsimple. Like give them access. The people want STRC on Wealthsimple. So I'm sure eventually maybe they'll get there, but right now it's it's only accessible through some platforms, and not just accessible through some platforms. We have heard and seen that they're incorrectly taking the withholding tax. So it's a return of capital. So it is a return of capital. It is not it's not like a foreign dividend that's supposed to be subject to withholding tax from the IRS because it's a U.S. entity. But it hasn't always been correctly applied. So I've seen some people like they're not getting withholding tax. I've seen some people who got withholding tax and then they got reimbursed for the withholding tax. And I've seen people who are still getting their withholding tax. So I think in the long term, it'll work out and it'll be treated properly. There shouldn't be any withholding tax because it's not a dividend by the technical term. It's a return of capital.
Okay. I think that's pretty much it here. So many people looking for the information on the STRC. So this is a hot topic today. Thank you guys so much for joining us. If you want to learn more, please join us at our Beat the Odds at Business and Wealth Bootcamp. That's happening on May the 9th, Saturday, May the 9th. You can still get some tickets. They're almost completely sold out. So we're still a few months away and almost sold out. So act today. Don't wait. Don't wait around. And if you like this content, don't forget to like, subscribe. Tell somebody that you love that think they need to get their money on point. Talk to you later. Bye.